Welcome everybody. Hello, this is the webinar for optimizing local currency debt financing for solar energy markets in Africa. And this is part of the webinar series for the Unlocking Solar Capital Africa event. And we're excited. It's 4 weeks away to the event in Kampala. So yeah, we had a big meeting of the events team yesterday. Solarplaza and GOGLA came together to with a T-minus 4 weeks to talk about our plans and where we're at, and it's looking good. We're pleased to say that we're looking at more than 350 attendees there in Kampala, 70 speakers, and a whole host of panels, workshops, networking, and matchmaking. So this webinar today is indeed a teaser for what is to come at the event, and we really hope it gives you a sweet taste of some of the interesting discussions that are going to happen, some of the interesting players that are going to be there, and yeah, a real feeling for what we're trying to do in terms of identify some of the barriers and solutions to unlock solar capital for Africa. And yeah, as I said, this is the third in our webinar series for the event. The first one looked at the investment landscape in solar in Africa. And that we had data from Irina that showed there is $3 billion of investment went to solar projects in Africa in 2022, $3 billion. But the potential is so much more. For household solar and mini grids alone, the potential is $19 billion per year. So there's huge room for growth. The second webinar did a deep dive on the household solar sector, or off-grid solar. And we saw that 2022 was a record year. There was $750 million of investments, and that includes $340 million of debt. We know that the majority of this was actually in hard currency. Fantastic that it's at record levels, but putting it in hard currency, it makes it expensive, it makes it risky, particularly with the volatility on the markets, and it makes it less inclusive. So we know some SMEs and some local banks are simply not part of this sector at the moment. We think there's an opportunity for them to play a big role. So today, the third webinar in the series is looking at just that, how local currency debt financing can play a role in growing the deployment of solar in Africa. So this is important because it can mitigate currency risks, it improves access for SMEs, it involves the local financial institutions, local banks, and that can all contribute to increased deployment of solar and economic growth and development. So today we have a really exciting lineup of speakers. We're going to hear from David Ekabuma of Greenmax Capital with their first loss facility, Frank Ajagba from the Africa Guarantee Fund and exciting LEAF program, and Nelly Len from TCX and their hedging currency facility. And yeah, introduction to myself, I'm Drew Corbin, the head of performance and investment at GOGLA. GOGLA is an industry association of more than 200 companies working in the off-grid sector, the productive use sector, weak grid sector as well. If you're not familiar with us, please check us out at gogla.org and we'd be happy to speak to you. And we're also organizing this event in partnership with Solarplaza. It's a Netherlands-based event company that organizes best-in-class events all over the world. So, practical notes for the webinar today. There's a possibility to ask questions to the speakers. You can find it in your on the bar on the right hand side. There's a chat facility, so there's going to be opportunity at the midpoint and at the end for questions. We'd love to hear from you and see if we can ask as many questions as possible. The presentation slides and full recordings will be available on the event website, and you will find a link to that later as well. If you want to check out the first two webinars, they're also online, so check out the recordings and the slides from that. And yeah, a word about Unlocking Solar Capital Africa. So I'm sure many of you are already familiar with it. It's the meeting place for companies, investors, and governments. This is the fifth in the series. The last one was actually in 2019, late 2019, pre-COVID. So we're really excited to be back again and really looking forward to being in Kampala. And there's three USPs that we're looking at with USCA. One is the investment opportunities that it will create. We're bringing together many companies of different different segments. Yesterday we were speaking about 50 African SMEs that are lined up, and we have a matchmaking session there, as well as many investors, lenders, development partners as well. So we know that people are there to network, matchmake, and do deals. Secondly, is the disruptive tech that's going to be showcased there. We have looking at tech segments from the household solar, productive use, mini grids, e-mobility, e-cooking, CNI, wheat grids, and more. So really, if you're interested in solar energy technology and innovation, what the future of solar in Africa looks like, I strongly recommend you to come along. And thirdly is looking at public and private partnerships. Africa is a difficult place to do business, and the renewable energy markets have got their own features that are requiring this mix of concessional and commercial capital. And we're looking to bring together the players that can discuss that and move things forward. So you'll see where the event is sponsored by the African Development Bank, the World Bank ESMAP, and Power Africa. Fantastic players to have there. We're also working with these partners and governments, and we're expecting 35 government officials from 20 countries, as well as a number of philanthropic funds, Shell Foundation, IKEA Foundation, as well as DFIs as well. So yeah, 3 areas: investment opportunities, disruptive technology, and public-private partnerships. It's now, yeah, so here's a discount code. Anyone that's listening in now or before the event can use this USC Africa 23 webinar 15, and you get a 10% discount on the full ticket price. Cool. With no further ado, we're going to turn to our first panelist, David Ekabuma, the Managing Director of Greenmax Capital. As you can read here, he's a seasoned pro working on investments across Africa and around the world with top credentials, and a really interesting initiative to kick us off today. So, David, let me pass over to you. Thank you.
Thank you, Drew. Thank you for the opportunity to present the Green for Access First Source facility. Before starting, I want to reinforce the context. What we know, recent estimates shows that Sub-Saharan Africa is still home to about 600 million people without electricity. What we also know that closing the energy gap through off-grid solution on the continent will require at minimum 3 billion of investment annually up to 2030. As you said, there's funding, but the funding that is provided to the sector is still way below the huge needs. Indeed, over the last decade, only 3 billion have flowed to off-grid energy access companies in the continent. Grants represent 4%, equity represent 42%, and debt provided for the most part by DFIs and specialized debt fund represent 54%. Most of it is in hard currency, and not so many African-based distributors or players have been able to access. That's why we believe local financial institutions must play Tom, my slides are not going through. Okay.
Yes, David, you can, if you click on the screen, you can gain control. Otherwise, you can always ask me for the next slide. I'll be happy to.
Yes, so go to the next slide. Next slide. Yes, this one. So local financial institutions must play a greater role in financing for various reasons. Access to hard currency, denominated debt expose DESCOs to currency volatility, which ultimately increases repayment risk and also reduces their margin, which ultimately make them less profitable and less attractive for equity. Financing needs are too huge to be absorbed only by the balance sheet of the DESCO companies, and also to be more inclusive by supporting locally based distributors as who are not accessing as much. So next slide, please. So what we know that local FIs have enough liquidity. We conducted a survey in 15 countries in from 2029 to 2020, and we found that local FIs have enough liquidity, over than 40 billion in the country that we surveyed. Next slide, please. We also know that local FIs that we are surveying are interested by the off-grid sectors, but concern over credit and lack of understanding prevent them from engaging at the level required. So they have the FI we have interviewed told us they have approximately 6 billion of pipeline, but they are scared of lending because of credit. Next slide, please. We also know that based on those discussions, having access to a stronger than usual credit enhancement and technical assistance will enable them to provide significantly more debt in local currency to the off-grid sector. Upon that, we decided to design a facility using an innovative approach to catalyze off-grid energy lending. Next slide, please, Tom. We have designed the Green for Access First Loss facility with the goal of unlocking end-user lending. Since we believe that on-balance sheet debt is not sustainable, and DESCO should focus on the core function rather than providing financing. As such, GreenMax, the G4A was designed to provide a funded first loss guarantee, which insulates up to 20% losses in a portfolio of end user loan. To mitigate risk, we build partnership with FI and DESCO who have a pipeline of deal. And it also builds the internal capacity of FIs, which are ultimately able to understand the risk and then to provide more funding. So next slide, please. We target the G4A foster to support more funding by supporting end users who are acquiring solar system, developer of mini grid and CNI, and also productive use of energy, agric obviously, and also e-mobility. So our focus is on the demand side. It's an initiative to provide a first loss protection on direct consumer lending of customers that are buying those equipment from DESCO. So the DESCO will not need to use the PEGO model anymore to finance those customers, but they will have access to a financing provided directly by the financial institution and also in local currency. Next slide, please. In terms of traction, what have we done so far? We are building the platform. G4X Diva is a blended vehicle to maximize impact while providing compelling risk-adjusted return to our investor. We are targeting at first close 5 million by end of Q3 2023. IKEA Foundation has already committed 1 million. At full close, we are targeting 50 million with a full close date here marked for Q3 2024. Next slide. And so far, next, you can go to the next. So far, what have we done? We are rolling out two portfolio of productive use energy one in Nigeria with Coolbox and Equity and FCMB, one in Uganda with Equity and Simisolar in the agri space, providing access to loan or small businesses in Nigeria, the case of Coolbox, to access solar power technology. So we are still busy fundraising to reach our 4 million to close the first phase, and we are also at the same time raising, increasing and building pipeline of local financial institutions and DESCOs with a pipeline of deals to be financed ultimately by those partner financial institutions. So our contribution in optimizing local financing, it's really by crowding in local financial institutions such that DESCO can focus on the core business function, developing good business model, developing good product that are affordable and reliable, and the financing bit will be taken care by a partner financing institution which are willing to provide the financing. Thank you. Over to you.
Thanks very much, David. Yeah, great to see that. Reminder to everyone in the audience, we are accepting questions. So if you've got anything to ask now, then please post it. And also we can have a Q&A at the end. Yeah, a quick one for me, David. So I'm sure you've been speaking to many banks across the continent. And what are their kind of main concerns when you're speaking about this? And kind of what's their kind of appetite when you talk about this first loss facility? Can you give us a bit more flavor as to how those discussions have gone?
So there's a lot of appetite. The reason being that the off-grid sector for the banks, it's a segment that they are interested in. Why? Because it's similar to asset finance. There's a clear asset that is identifiable that needs to be financed, and they can repossess it. The only thing that is preventing them, it's credit risk and lack of knowledge. And when I say credit risk, it's perceived credit risk. We are talking about a new type of user in remote area, rural area that they don't know. So for a bank to invest in that segment and without jeopardizing savings, your saving, my savings, they feel that they need sufficient comfort at the beginning, learn the ropes, understand the risk, and once they have gone past that learning phase, they will be able to mitigate those risks and then to finance. That's what they are saying. And that's where the first loss protection, which insulate 100% or the first 20% loss in the portfolio, is an appealing proposition.
Well, and that's your exit strategy wrapped up right there as well, right? You know, you're about getting them comfortable, gaining the experience, familiarity, serving these customers, working with these players, with the idea that the banks in the end will be ready to lend without that support.
Exactly. We need to play a catalytic role. We are playing to get ourselves out of the market within 10 years maximum by helping them to understand, helping them to mitigate, matching them with descos who are able to originate deals for them, building those partnerships to create a sustainable and conducive environment.
Well, it'll be a fun 10 years. Good luck with it. And yeah, let's move on to our next speaker. We have Frank. Thanks, David. We'll come back to you later for the panel. And yeah, for now we have Frank Ajagba, Group Director of Business Development at the Africa Guarantee Fund, and I know an old colleague of David's as well. So yeah, great to see you guys back together. Yeah, you can check Frank's credentials here, and we're going to hear about the interesting work and opportunities that are coming up with the Africa Guarantee Fund. So yeah, Frank, over to you. Thank you.
Thank you, Drew, for giving us this opportunity and this platform to share what AGF is doing in terms of optimizing local currency debt financing for Sub-Saharan solar energy markets. But before diving deeper, I would like to highlight some challenges that we see in the markets, and after I will show you how AGF is part of the solution to solve these challenges. Tom, I'm trying to move my slides, but I'm not successful. Okay, thank you. So, as fact, David touched base quickly on some key aspects. Tom, can you move the slide, please? Yes, some key aspects. The first one is we all are aware of the gap, the financing gap for Sub-Saharan solar energy markets. But in terms of fact, we can see quickly that when you look at these slides, David talked about 600 million African population that don't have access to electricity. The 600 million, you will see that the far they are from the, or I will say the easiest one to the easiest one to provide electricity to through off-grid are the one, they are around 400 million, and they are the one that are far from the grid, the existing grid, and that are not, in terms of population density, that are not high. So these two categories are critical for off-grid if we want to bridge this energy gap. So another fact is that out of the 100 billion per year that we will need to bridge the gap by 2030, only 90 billion will be needed for green and mini green and standalone system. And so far, 1% of this 90 billion were funded. So the gap is still huge. The gap is still huge. And next slide, please. And for what we are doing on the market, we noticed that local financial institutions represent a huge source of funding well suited to meet the need of off-grid enterprises. Okay, and the currency volatility presents a big challenge for off-grid company with a mismatch of liability in hard currency and revenue and asset in local currency. So what does it mean? This means that today or currently, the supply side of the off-grid and the investor use hard currency to finance the sector, while the receivable, the end user are paying in local currency. And when you have a look at this table, you can see in Ghana, for example, how the FX risk was high, 40%, okay, in 1 year. So next slide, sorry. So the key lending constraints that we identify in the local market are the collateral inadequacy, the lack of credit support, and the worsening in the NPL in this energy market. And next slide, sorry. And this is where AGF approach to local currency financing, can play, demonstrated its efficiency and the key role it's playing. So AGF, as you know, is a Pan-African guarantee fund rated AA- by Fitch since many years now. What we provide a partial financial guarantee to banks and financial institutions so that they can on-lend easily to SMEs. And AGF has a track record in designing and rolling out credit mitigation instruments to foster climate finance. Our first experience with in the green sector was our green guarantee facility that we designed almost 6 years ago, and that we use to promote the climate finance and that we use to support the financing of green projects in Africa. So far, we are partnered with 200 financial institutions across 40 countries in the continent, and this is our outreach is the first answer that will help to optimize local currency debt financing for Sub-Saharan Africa energy market. The reason why I'm saying that is simple. The guarantee, we provide guarantee in local currency, okay? And that is the key point of our discussion today. It's very difficult for financiers to invest in or to raise money in local currency to support a green project. And this is due, as I was saying earlier, to the FX rate. So the value proposition that AGF put on the table for the sector is one, guarantee in local currency, but we don't just issue guarantee, we combine with capacity development to enhance banks' understanding of the sector, because the way to access a CNI transaction is different from the way to access a solar home system project, and it's also different to assess risk on mini grid. So the capacity development that we provide help us to enhance the capacity of the supply side, so the banks, and also can be used to enhance the readiness, okay, of the SMEs. So we offer our product in concessional terms, in terms of coverage and pricing, and we help SMEs, we help banks, sorry, to grow their portfolio and their green portfolio by sharing the risk they are taking on the SMEs. So one, to enhance what we are doing with our green guarantee facility, we are, next slide, we will be implementing the LEAF program, which is the leveraging energy access to finance. It's an AFDB and AGF risk sharing mechanisms that aim to help in 6 countries: Nigeria, Kenya, Ethiopia, Guinea, and Ghana, and Tunisia. The aim of this project is to help to bridge the gap, the energy gap, sorry. It's helped to bridge the energy access deficit and market potential across the different markets. Okay, and it's cover off-grid CNI, green, mini green, and SHS, sorry. So to leverage on this program, the opportunities, or the supplier and the demand who are located in these 6 countries, okay, can approach us. We will also approach them, and basically what we'll be doing will be we will be incentivizing the local banks to on-lend to the energy company, okay, and sharing the risk they will be taking on this company. So as, sorry, next slide. As industry recommendation, how to scale up local currency financing, according to our experience on the ground, I think the risk-sharing mechanism is important to unlock more financing from local bank and financial institutions. The capacity development aspect is very important to enhance financial institution understanding of decentralized renewable energy, different business model and risk assessment. On demand side, we'll need the capacity development to design and support decentralized renewable energy tailor-made training to enhance their financing readiness. And in terms of efficiency, we also need to partner with specialized energy advisory firms. Sorry, and most importantly, we believe that it will be very important, very key to promote local content, because if we are able to manufacture solar panels, battery, and all this in Africa, I think the FX risk will reduce because we'll not need a hard currency, okay, to buy this asset. I'll pause here and over to you, Drew. Thank you.
Yeah, thanks, Frank. Great to see these opportunities. Can I ask? I understand that you're still in the design phase at the moment. When can you give a sense of the timelines for when some of the opportunities will be available for local banks? When do you expect this guarantee fund will be online?
Even before the finalization of the LIFT program, AGF have already in place a green guarantee facilities, okay, that can cover all the needs of a financier or an energy company. This said, the LIFT program, the way we are moving, should be out, I can say, last quarter of the year.
Okay, so good to hear. So there's something already available, but it's going to be boosted by the LEAF program later this year. Cool. There was a question has come through on the chat from Matteo Gilardi saying, when talking about local financial institutions, do you refer mostly to microfinance institutions or commercial banks? And who is most suited to use this guarantee facility?
The main users of our guarantee facility are the commercial banks, okay, microfinance institutions that are all lending to green facility, green project can also be eligible. I will also want to take this opportunity to say that we are also designing a second program that will be dedicated to microfinance institutions and fintechs, okay, to reach the bottom of the pyramid. And yes, if any microfinance institution is willing to support a green transaction, for sure we can have a look at it. But most of our customer today, our partner today, are commercial banks.
Well, good to know. Thank you. And yeah, we'll see you again shortly for the panel discussion at the end. And yeah, so I'd like to introduce our final speaker, Nelly Lin from TCX. Nelly, great to have you with us to talk about TCX's services and how you're supporting local financial institutions and local currency debt. So yeah, please take it away.
Thank you very much, True, and welcome everyone also from my side. So yeah, I'm Nelly. I'm a trader in TCX and TCX. So just to give you an overview of TCX. So we are an Amsterdam-based development finance initiative. We were founded in 2007, so more than 15 years ago, with the purpose to protect lenders and borrowers from exchange rate volatility in all emerging and frontier markets. And we do that by offering currency hedging solutions. So a slightly different approach than what we've heard so far. And we usually come into place, or we come into place when there's no market for certain currencies, or when the offer on the market is limited. So in terms of tenors, there we can step in and offer very long tenors, even in the most frontier currencies. And to show what I'm meaning by emerging and frontier markets we are active in, so we cover all countries you see here in dark gray, so especially in Africa, with a few exceptions, almost the whole continent. And what is it exactly that we offer? How is a local currency loan structured with TCX? So we have a local borrower that can be, for instance, a home system developer, and that borrower has no or limited access to onshore funding, so onshore in the country, so and an offshore lender, offshore meaning not in let's say Tanzania or Ghana, but in Europe or the US. So for instance, a development finance institution can offer that borrower a loan. And then TCX enters into a contract with the lender, into a hedging contract, and we absorb the currency risk of the loan. So the lender is able to offer a local currency loan to the borrower, and the lender does not take the currency risk, neither does the borrower, because the currency risk is absorbed by us through a swap that we provide with the lender, where we buy the local currency and provide US dollar to the lender. And when I'm talking about lenders, so here are a few names of lenders we work with, of our clients, but also our investors. So the smaller bulk on the left side, FMO, KfW, and others. These are among our investors, so we work with them a lot. So any loans that are provided from these institutions to the solar market could be hedged through us. And then there is a large bunch of other lenders and impact funds and fund managers that we can work with. And it is important to know that we are sector agnostic, meaning that we can hedge any sector, from solar home system, mini grid, CNI, e-mobility, any kind of sector. And this is just to give you an overview of the names that we can work with, and with the borrowers that we have worked with in the past. And this is also just some examples from real life transactions we have done. So I think solar electric, you've heard it before already. And there we could support a facility from FMO and Symbiotics, so that solar electric could borrow in Tanzanian shilling, and for solar now similar in Ugandan shilling in the market. And on the left you see our portfolio. So these are figures from last year, from 2022, and we make 5% of our total portfolio has been in the renewable energy sector, and we would love to see that number increasing in the renewable energy sector. But as the renewable energy sector is a heavily US dollar funded sector, but one of the big issues we see are the cost of funding, and especially the perceived high cost of local currency funding. And to demystify that a bit, we would like to quickly go through how is a local currency interest rate, what feeds into the pricing, so what is it built up of. So the first block here is the lender's return, so that would be the return the lender requests, also if the loan was also in US dollars. So the lender requires, in our example here, that is an example from Tanzania, figures of course only to showcase, he would require an 8% annual dollar return, that reflects credit risk and also US dollar rates. And then the orange block here below is where we come into play. So the cost of FX hedging, driven by macroeconomic risk, financial risks, but also social and political factors. And here in the Tanzania example, for instance, that will be a 5% annual rate for Tanzanian shilling. And these two blocks together, simply speaking, then make up the local currency interest rate of 13%. But of course, this rate varies by, of course, over time, given recent developments, but also of different structures and maturity and amortization profiles of a loan. But even more significantly, pricing varies per currency. As I said, macroeconomic risks or credit risks play a large role or for pricing local currency loans. So what we have here are three examples, one from Tanzania. So this is the same example you've just seen. And then Madagascar and Sierra Leone. And we see as financial markets become less developed, risks and risks become higher, also the rates increase. So for instance, in Sierra Leone, the cost of hedging reaches 16% in our example here, but also the lender's return increases as the risk increases, making up a total local currency interest rate of 27%. So what we see for the sector, there's a need to incentivize local currency borrowing, because these prices reflect risks and the risk of depreciation also. So we were working on kind of finding solutions to more affordable hedging products in the energy sectors particularly. And our recommendation for the sector would definitely be to explore opportunities for concessional financing, and we are always happy to support here. And thank you very much for your attention. And I have brought with me my colleague Demba, who might also be able to answer some questions. And yeah, thank you very much.
Thank you very much, Nelly. I'll go straight to a question from Thomas DeVoe in the audience. He says, can TCX do Naira, e.g. absorb currency risk in Nigeria? And if yes, at what cost?
Yes, we can. We can absorb Nigeria. In Nigeria, liquidity, US dollar liquidity is sometimes an issue, but we can hedge Nigerian Naira. And for cost instructions, I would say, yeah, best to contact us directly, and then we can explore. As I said, it varies really much by different structures and by, yeah, but we can.
I see Uvi Ugono has also asked, what is the currency cost of FX hedging for the Nigerian Naira? So an interesting market for your services. Yeah. Yeah. Cool. And yeah, maybe another one here. How does TCX local currency cost compare with local commercial banks' loan pricing?
So we do not compete with local banks. So as I said before, one of our main principles is additionality. So we only come into place when there is no market or no commercial offer available. And that is why, yeah, our pricing is risk reflective. So doesn't similar, but of course we offer structures that these local banks usually cannot offer.
Okay, thank you. And yeah, with that, we'll now move to we have 12 minutes left to answer some of the questions that have already come through from attendees. So I'll invite David and Frank to come back. And Tom, if you can also kick us off on our audience poll question to get this to start the Q&A. So yeah, please everyone turn your attention here and complete an answer. What is the main barrier to local currency debt financing for solar in Africa? A limited pool of investors, a limited capacity of local financial institutions, poor creditworthiness of solar companies, lack of track record of solar companies, or regulatory barriers and political risk. So yeah, pick one and we'll check the results in a second. And I think all three of our speakers have given some hints along the lines here, so it'll be interesting to see which of those hints have been picked up, and where the sentiment lies on these different elements. So we should have the answers coming through now. Yeah. Okay. It's a reasonable spread, but the top one is the limited capacity of local financial institutions, followed by the limited pool of investors and poor credit worthiness of solar companies, coming in an equal second place. I believe both Frank and David, you've got programs doing capacity development supports to local banks. Is that correct? And can you say a bit more about kind of what you've learned in the development process and how you intend to deliver them? Maybe David, go ahead.
Yes. I totally agree with the limited pool of financial institution, because so in terms of limited pool, there are limited amount of financing to be unlocked. So that's for one. In terms of limitation, you don't get the benefit of the competition. And as a borrower, when you walk in to the only bank in a given country that provides you finance, there's only one term sheet that you will have. It's from that provider, and also us from credit risk mitigation provider. We want to talk to as many financial institutions as possible to unlock, to create that market, and also to have more favorable terms for the end user. So definitely one way of crowding in, and that's why all the solutions that we have discussed here, it's not just only providing the credit instrument, but making sure that you are building the capacity of the partner financial institution, and you do that to as many banks as possible. That's why we don't go with a pool of bank, but we want to have in a given country at least 30–40% market penetration to make sure that we have a maximum impact.
Yeah, thanks, David. And Frank, can you say a bit about the capacity development support plans from the African Guarantee Funds?
Yes, from African Guarantee Fund, I think we do support financial institutions by providing also what we call bank fundraising guarantee, okay, to help them to raise funds even in local currency. But now to come to the pool, talking about the pool, I think it's a mixed reasons. It's a mixed reason, but I will touch base about the reality of risk reality versus risk perspective, the risk perception. Why? Because the fact that the off-grid sector is still new, even for the bank and financial institution, the risk appetite is very low. And one thing that African Guarantee Fund is doing currently is through what we call the Green Finance Series. Okay, it is an event that we organize where we bring together all the stakeholders, supply the one side, and raise awareness. And this is followed by 2 days training on green for the bankers. The next edition will be in Malawi in the next week. Okay, So that's a kind of thing that African Guarantee Fund is doing to democratize, if I can use this word, the funding to the sector.
Cool. Yeah, good to know, and sure any of the attendees in Malawi will be interested to hear that. A question that came through earlier, and I think it's good for David and Frank. How is the guarantee intended to be priced, and are commercial banks willing to reduce their lending margins in light of a first loss or a credit guarantee, and what reduction are they offering? And that question was asked by Farid Mohammed, who's been very active on the chat. So thanks, Farid. And maybe this time we start with Frank. Yeah.
Yes. So if I take the lift, even what we are doing currently with the green guarantee, the incentives, the features of this guarantee are very interesting for banks. We increase the coverage up to 75% instead of 50% for business as usual. So the bank have already 25% of his skin in the game first. And secondly, we give a discount in the pricing for the bank. So instead of passing on the guarantee cost totally to the end user, to the SMEs, the bank, we have already provided a discount, so the bank should be able to pay or to, just not to pass on the cost to the SME. So I think it's a way to reduce the guarantee cost and the credit cost to the SME. Thank you.
Yeah, thanks. And David, do you expect that the local banks will be able to reduce the rates for SMEs with this first loss facility?
That's a goal, but the reality is the way banks are seeing guarantee and fees associated to guarantee, it's an additional cost of capital. So they consider it in addition to the cost of capital, and they pass it through. So what, which forces? So the pricing is based on two components. We form a partnership where we are bringing DESCO and we are bringing a bank. So we are doing a due diligence on the two sides of the partnership. So based on the weighted risk profile, there's a pricing because we know that that pricing will ultimately go to the end user. We have, and also there's competition in the credit market, in the guarantee market. They will compare first loss that we are providing to SIDA guarantee, which is purely public funded, or to AGF, which is a pari passu guarantee. And you cannot change it. You have to play with the parameters of the market. They are passing the cost, and that's why I believe in market forces. The more banks we have, the more they will compete for the same market, and then they will be the one reducing the cost, because otherwise someone will compare how you are offering me these terms and another bank is offering me 0.5 bp less. Make your choice. So that's what I believe in, that rather than imposing on them the obligation to reduce because they have the guarantee. I don't believe it will happen.
Yes, so the big win at the moment is stimulating more activity from local banks, getting more players interested, getting more players comfortable, and then the market forces will decide between supply and demand about where the prices and that dynamic element goes. Cool. Yeah, I'm looking at the clock and I see it's ticking down to the hour. So there's plenty of more questions that have come through. We won't have time to answer them. For the specific ones, we'll try and get back to individuals with that. But really, the best thing is to come along to Kampala, find David, Frank, and Nelly there, and have a chat. And that's the opportunity to really explore this more. Yeah, again, it's May 1st and June 1st in Kampala. And Tom, can you just put up the last poll quickly for the audience? Let's close this out. So, and which session are you most looking forward to at USCA? The local currency debt financing workshops, where we'll be in a room together to explore these discussions and learn more. The company investor matchmaking and pitching. The opening panel with World Bank, AFDB, Arena, and others on scaling solar for just energy transition, the promise and potential of carbon finance, or to just look forward to having a beer and a cocktail in your hand by Lake Victoria and trying to find Nelly, David, or Frank to ask your question. Please fill it out. Let's see. Hey, surprise, surprise. I think we have selection bias here. The local currency debt financing is the one that the audience are going to go for. Cool. And I won't tell any of the opening panelists, they only got 3%. So yeah, I'm not sure if any are on the line, but otherwise, let's not let that one out. Cool. And yeah, here you can see the discount code again for USCA. Please feel free to use this, but also if you want to pay full price, then you're more than welcome as well. And yeah, it's going to be a good event, 4 weeks time. Do check it out. If you have any questions, queries, let me know. We still have some opportunities available for exhibition booths. There's some brand sponsorship opportunities if you're looking to get your brand up there amongst some of these other players. 1 or 2 speaking slots, although that's closing quickly. So yeah, check it out. I encourage you to keep an eye on the website. We're updating that frequently with new speakers. Lots of attendees coming up as well. Yeah, it's going to be a good one, and I look forward to seeing as many people as possible there. And with that, yeah, we'll close. Massive thank you to David, Frank, and Nelly for their time and sharing their initiatives. And yeah, thanks to everybody who joined the call to listen in. It's been good. And yeah, we'll see you in Kampala.
Thank you. See you in Kampala.
Thank
Thanks,
you.
everyone.